Why is reinsurance needed? Insurance companies prefer to reinsure as a part of their risk management plan. It gives them the freedom to carry out business on a large scale and offer great benefits to policyholders without worrying about the losses they might incur. The basic definition of reinsurance states that the reinsurance companies offer to cover the losses of insurance companies after reaching a certain limit. You can say, it acts as a stop-loss for insurance companies. Here is why all insurance companies should include reinsurance in their risk management plan. The main objective of reinsurance is to save insurance companies from potential losses that might occur at the time of uncertain natural calamities. Basically, it is spreading out risk in order to save the company from going bankrupt. Reinsurance also gives the opportunity to insurance companies to expand the business without adding any extra capital. Moreover, it allows insurance companies to increase the number of policyholders without worrying about the settlement of claims. The main need for reinsurance arises if the company has exposure to natural calamity claims. This is significant because when insurance companies have committed to settle claims due to natural calamities, it generally results in a lot of people filing for claims together. For calamities such as floods, tsunami, cyclone, etc., a number of claims can come from a single location. And in such case, if a company is lacking a reinsurance policy, it can create a lot of financial burdens. However, if the company has a reinsurance contract, it can claim some part of claims reimbursed so as to ease the financial burden. Reinsurance companies are experts at analyzing the risk factor and accordingly recommending a suitable plan. It is crucial for insurance companies to work with experienced reinsurance companies so as to avail the best benefits. NVT, in India, is one of the best reinsurance providers. Check out the website to know more about the services provided by NVT. There are several reasons. The most traditional is that an insurer has sold a policy that is larger than it wants to totally keep. The reinsurance is a way of spreading that risk to other insurers to limit each company's risk. Sometimes, a company wants to sell a policy but doesn't have the technical knowledge to design or price it. The reinsurer might offer to provide the product in exchange for a share of the sales. Another reason is that reinsurance is used to transfer a risk when an insurer wants to exit a business. Most M&A in insurance involves reinsurance because an insurer can't sell a policy and reinsurance accomplishes the same thing. There are also financial management reasons and tax reasons, but those are very technical and sometimes controversial. Reinsurance broadens the risk-sharing pool, thereby diluting the impact of losses on insurance companies. Lloyd's of London is an example of a reinsurance pool whereby extraordinary, unusual and extra-large risks are assumed by risk-takers. Insurance companies use reinsurance to hedge their insurance risks and be able to absorb the impact of cataclysmic events, hurricane, volcanic eruption etc., that trigger large losses. If an insurer keeps 100% of the risk, the insurer will assume all the liability and may have the chance to lose money when claims arise. If an insurer keeps 0% of the risk by buying 100% reinsurance, it essentially becomes a broker. It is earning the spread between the rate it is charging the policyholder and the rate it is paying the reinsurer, minus the operational costs for handling the policy. The game becomes interesting when it is somewhere between 0 and 100%. Insurers and reinsurers have different appetite of risks. For example, some of them prefer property, some prefer liability, some prefer excess liability. By theory, they will try to optimize the portfolio to yield the highest expected profit. By practice, they give business to each other so they can have more beer.